The permanent portfolio is an investment strategy with over a 500-year history. Jacob Fugger, a German banker and reportedly the richest man in the world in his day, first documented this investment strategy. The strategy is straightforward and simple. It is designed to hedge all economic scenarios at the same time. These 4 scenarios are inflation, deflation, prosperity, and recession. One of the modern-day fathers of the permanent portfolio, Harry Brown, has been instrumental in its development and design. In my 1998 book, The Money Management Game, What They Don't Tell You About Mutual Funds, I outlined one of Brown's earlier portfolios. In his 1981 book, Inflation Proofing Your Investments, Brown updated his model, which now included 4 asset classes with 25% invested in each. These 4 assets were gold, the S&P 500 stock index, 30-year treasury bonds, and cash. Gold is the inflation hedge. The S&P 500 stock index is there as a prosperity hedge. 30-year treasury bonds hedge against deflation, and cash is the recession hedge. Brown suggested rebalancing the portfolio once a year. For example, if gold is 27% at the end of the year, the investor sells the 2% excess weighting and puts it into an asset class that has underperformed with a weighting below 25% at year end. Taking Brown's model back to 1972, 6 months after the US went off a gold-backed dollar, the portfolio has done 9.67% compounded annually. This performance is near equal to equity market performance over this period, but with much less volatility. Remarkably, over this period, the portfolio had only 3 down years, the worst being a loss of 4.1% in 1981. This table is the same data as the previous graph except in numerical form. The annual performance numbers are down the right-hand column. The red numbers denote years with losses. This portfolio design has had 37 out of 40 years of positive investment returns. At the Philippiate Group, we have taken this model and adapted it for our clients. We rebalance the portfolio a minimum of twice per year and will do it more often if markets are volatile. The more one rebalances, the better the performance. The reason the permanent portfolio works is that one of the asset classes we are invested in will be in a bull market. The other assets aren't necessarily going down, but they will not be doing nearly as well as the bull market asset. For example, from 1972 to 1980, gold was up over 2,400%. During this decade, compared to gold, U.S. stocks did very little, but while gold was rising, its weighting in the portfolio kept increasing, so gold was being sold and moved into equities that were lagging. When equities finally bottomed in 1982, the investor had more stock and profited from the rise in the equity markets of approximately 1,300% over the next 2 decades. Over the past 100 years, if one had owned 20 to 25% in gold in one's portfolio, that weighting would have been more than enough to hedge financial meltdown in the country that one resided. Using Iceland and Argentina as more recent examples, you can see how this would have played out. An investor owning the permanent portfolio designed for these 2 countries would actually have more money after the financial crisis because of the permanent portfolio than they did before. We live in a world where the equity culture is quite strong and most portfolios own a disproportionate amount of equity or stocks in their composition. Unfortunately, this can lead to terrible underperformance for long periods of time. Using 2000 to 2011 as our example, you can see how much better gold has done over this period in relation to stocks. Very few money managers owned gold at the turn of the century, and very few own it now. There's no way any of us can properly time asset markets over the long term, and the permanent portfolio shows you that you don't even have to try. Over the financial crisis years of 2007 through 2009, the permanent portfolio actually made money. As many can remember, the S&P 500 stock index did not fare nearly as well. As one can see in the chart, an investor made money in 2007 and 2009. This is outstanding performance. Most brokers or advisors don't have an overall strategy. They change things periodically based on asset values or technical analysis. This methodology is seriously flawed. In today's uncertain world, a disciplined and proven investment strategy is needed more than ever, and the permanent portfolio delivers what investors need. The Canadian and U.S. permanent portfolios offer outstanding long-term portfolio performance, a proper diversification over all necessary asset classes, low portfolio volatility, a methodology for profiting from asset volatility, a solid gold weighting to hedge against financial calamity, and a tax-efficient portfolio.